market, somewhat surprisingly to me at least, just sort of tried to whistle by the graveyard going into that announcement. And obviously, we're seeing what we've got here this morning. You've got a very broad-based tariff application here, really around the world. We went through the exercise last night of looking at the 45 largest U.S. trading partners that account for the vast majority of our trade balances around the world. And we, on a weighted basis, applied the reciprocal tariffs that were being imposed, inclusive of the step up in China from 34 to 54. There's a little debate there over whether it's actually even higher than that, kind of going back to some Trump era one tariff levels. But regardless, it puts you at about a 28.5, maybe even slightly above that, percent fully loaded tariff rate globally, which is certainly extraordinary and puts us in a very, very different place than we've ever been in. Well, I shouldn't say ever, but then we've been in a very long time. And by very long, I mean over 100 years. And so it does raise a lot of questions around what are going to be the impacts here, both from a inflation and a growth standpoint, obviously. I would say on the inflation side, and this is something I've been, having conversations certainly with clients about, it's certainly a challenge, right? Because there are, we have our framework. Our framework, I think, works very well. We've been on the right side of these, pendulum shifts in inflation consistently now for quite a while. I would say the challenges with what's, was announced yesterday, what's being implemented now is really threefold. One is obviously this question around how much did inventory and raw materials get preloaded, right? Companies basically bringing things in ahead of the tariffs, buying themselves basically some time. So that's an unknown, and it's going to vary by company and by industry. The second big unknown is the demand reaction function, right? So, what is going to be the response on the part of consumers to, attempts to pass through these tariffs in the form of higher prices? And the answer there too is unknown, because it's going to, again, vary by company and industry. And then finally, and maybe the biggest unknown, is what will companies and industries try to do? Will they try to pass through the increases? Will they choose to absorb some of that in the form of lower margins for their own business? And that too is unknown. But I think what's clear is that it's going to be some combination of those dynamics. So the thing that's extremely likely is that you will end up with a reduction in margins, corporate margins. That seems very high probability, and probably going to see some significant pass-through in the form of higher prices, though the lag on that is not crystal clear. Where it gets a little bit more interesting, a little more uncertain, is, if you have enough of a suppressive demand reaction function, then you could end up with actually a sort of disinflation dynamic, sort of overwhelming the tariff-driven inflation component. So a lot of uncertainty there, but I think our framework, our system is quite good, especially at the nowcast in periods of pretty significant upheaval, which I think this qualifies as. So as we've been saying for a while, we will continue to lean into your signals and to lean into our nowcast framework. Obviously, our forecast framework remains our base case probabilistic path. But I do think, the signal and the nowcast is going to be extremely important here in helping to navigate what's going to be, I think, a very tumultuous period over not just obviously this morning in the last 2 months, but really over the coming year.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.